Life insurance is a big deal. It's probably one of the most important aspects of your entire portfolio. And the reason it doesn't get discussed a lot with a lot of retirees or people getting ready to retire is because most of you have probably been approached by an insurance agent who is only talking about the insurance piece itself, protecting your mortgage, or even protecting the life of the breadwinner. That's just part of the aspects of life insurance. There's also the investment component and the whole legacy planning, but now they've added another component, which is long-term care. So when we're trying to find the most flexible investment vehicle out there, life insurance is actually at the top if used properly. In fact, your wealthiest people in the world, the most wealthy people in the world, use life insurance to pass on to their heirs. Passing on assets to your heirs, obviously through legacy planning, is very important. But now we have living benefits. Living benefits are those like critical illness, chronic illness, and even terminal illness. So terminal illness, let's go through 3 of these. Terminal illness, if you're going to pass away within 12 months, a lot of these different insurance carriers will actually let you accelerate that death benefit while you're living. If you have a heart attack, you could actually accelerate that death benefit and access money to pay for those bills. Okay, it might be a heart attack through considered a critical illness. And the most important rider is chronic illness, which is long-term care. So if you can't meet 2 out of 6 activities of daily living, you can actually accelerate that face amount of your account. Many companies let you do as much as 24 to 25% per year, or even some even let you do 4% per month or 48% per year. So that's a lot of money you can use to take care of a need that most people are not wanting to pay for directly because they know how much it costs. And what I'm referring to is regular long-term care. So buying a regular long-term care policy by itself is very costly. And if you die of a heart attack, it doesn't pay anything to your heirs. But imagine having a life insurance policy and a long-term care rider. So if you were to pass away due to a death benefit, due to some illness, and you just passed away of a heart attack or whatever it may be, that death benefit is going to pay out tax-free. But if you needed it for long-term care, they're going to let you accelerate that benefit at the percentages I just stated. But it also has another component. It has tax-free access. So tax-free access is through the cash value accumulation. So many of these policies can actually be designed so that you accumulate wealth within the product. You can borrow up to 90% of that cash value tax-free. Again, there's only 2 things tax-free, actually probably 3, 529s for college education, which you're probably already past doing that. You've got Roth IRAs, and then you've got life insurance. More times than not, if someone's choosing between Roth and life, the life policy, believe it or not, becomes the choice and the method of choice because it does so much more. But that's where the analysis comes into play. You got to weigh out these different factors. But when you got a tax-free death benefit, tax-free long-term care, tax-free access to the cash value, all those things are going to magnify the benefit of using life insurance.